Good morning. We're delighted to have with us here this morning two of the three executive committee members, and I want to welcome Jack Tompkins. Jack, thanks for jumping in with this interview today. I want this to be very informative, transparent, and really give a good State of the Union. You've got total license. You can do exactly what you want to do, and this is your story. But I want to start by give the shareholders an opportunity to get to know you, your background, your history, experience in business, experience with Mr. Hartman, how long you've been with the company, and then a little background on the operations of the company over the decade or so that you were with it. So with that, Jack, start from the beginning.
I was very privileged to be able to attend Baylor University. Baylor University has one of the best accounting programs in the state. And so I attended, received a BBA there. Shortly thereafter, received a Master's of Business Administration, concentrating in accounting, finance, but really all areas of the School of Business. I wanted to become a CPA, and with the background that I had at Baylor, I found passing the CPA exam was not all that difficult and became a CPA. I joined a CPA firm known as Arthur Anderson and Company, and I was with them for 15 years. It was a great experience. Arthur Anderson was kind of the gold medal card at that time. And after that, one of my clients asked me to join them and become their senior vice president and their chief financial officer. I had about 7 different vice presidents reporting to me in all areas of the company. So I believe I added a lot of value there to that company and trained some really good people at the same time. After 9 years, I rotated out because I wanted to be an entrepreneur. But my first venture was to actually form a REIT. That was very fulfilling to me. I knew quite a bit about real estate and about finance and public companies. So I joined with a partner, and we formed a REIT specializing in the real estate of automobile dealers on a nationwide basis. And doing all that, we got some of the best firms to sponsor us as far as taking the company public. And just at the moment we were getting ready to go public, I got a call from another public REIT asking me if I would be interested in selling to them or if I really wanted to run a REIT. I thought about it hard looking and just looked at the financial aspects of it, and we sold to the public REIT, and it turned out to be a very good venture. Not long after that, I joined Crescent Realty, one of the largest REITs on the New York Stock Exchange, as executive vice president and chief financial officer. I think I further honed my skills in the REIT and the real estate business at that time. After Crescent rotated out and started buying companies and selling companies and forming companies from scratch, had a very profitable time, a very enjoyable time in the entrepreneur field. In about 2009, my friend Al Hartman, realizing that I had a whole lot of experience in the financial field, the audit field, and in the REIT field, asked me if I would be one of the
Let
first.
me interrupt you if you don't mind. One little quick question here. The best way to learn how to run a company, to understand the company, and to know the financial and the operating side of it is to be an auditor and start with the cash and see how it turns into revenue, expenses, control it, and results. Is there truth to that? And did that help you in your entrepreneurial experience?
One of the main reasons I wanted to enter the audit field from the very beginning is that I wanted to learn the business from the bottom up. And being just a newbie right out of the university, jumping into auditing where you're starting with cash, you're looking at receivables. I had multiple clients, and so I could see those that were very well managed and those that were so-so and those that were not also. I saw failures among clients as a result of that. So from a learning experience, I think public accounting was just a fantastic privilege for me.
Okay, so go ahead with what you did after the sale of your REIT to a public company.
In 2009, my friend Al Hartman we'd known each other for quite some time, and he realized that I had a lot of business experience along with REITs, audit, finance, and other aspects. So he asked me if I would be on the board of directors of Hartman 20 as it became a public non-trading REIT. As a result of those items, I felt like I was probably qualified in my friendship with Al. Then I agreed to become one of the directors.
And what was your experience with the beginnings of your relationship with Mr. Hartman? You mentioned that Mr. Hartman, a friend, asked you to come in because of your expertise. How did the friendship develop?
Actually, Al and I met each other at church. We found that we had a whole lot in common. So we found ourselves at church on a regular basis, just chatting, and we chatted about a large range of topics. Some of them were church, and a lot of them were business related and family and so forth. So over a period of years, we'd gotten to know each other fairly well.
And at that time, did you have significant confidence in him?
Al seemed like that he was an upright citizen. He seemed like that he was a knowledgeable businessman, and he seemed like that he was committed. When he raised money to his shareholders, it seemed like to me that he was really wanting them to have a good return.
I want to cover your background. I want to talk about where we are today. There's nothing more important than the present, the future, what we're doing. So I'll just ask you one simple question. What did you in the early years learn about Mr. Hartman that led to the decision that was made in 22 late when the executive committee was formed?
Over the years, as I sat on the board, I noticed that Al was more and more detached from the company. At the beginning, he seemed like he was very involved with the company and very determined for it to be successful. And over the years, he seemed to delegate more and more to his other officers and just really not seem to really be aware of that much of what was happening in the company. Even though he was chairman and CEO, in the board meetings, oftentimes he was asking basic questions to the management team. So Al became more and more detached from the business. And through a period of time, I realized that he was just so busy with his political endeavors, with his nonprofit endeavors, all of which were worthwhile. But the problem was he was delegating everything to his officers and not even really understand what that much about what was happening in the company. And I think that was a real shame, because that led to the beginning of the demise of Hartman 22.
What was your reaction when Raymond James advised the board that the company was burning cash, summer of 22, negative cash flow, and Mr. Hartman disavowed it, said it was not true, and your feelings about the situation at that time?
Yeah, well, numbers don't lie. And we had the numbers that proved that we were moving into a negative cash flow situation, especially if we did not discontinue the dividend. Even though Al was demanding that we continue the dividend, the numbers said we just simply did not have the cash to pay the dividend. And so that was a fairly decision right there, where the board decided this is not working out very well. Can we really afford to have Al as our leader? We began thinking about that at that time, when we had to demand from Al that the 20 put the dividend on hold.
Was it an easy discussion, or was it a strong pushback?
And there was a strong pushback, and Al kept insisting that the company should not discontinue the dividend. And our heart said the dividend should continue, but our financial analysis said if we continue the dividend, the company is going to very quickly move into a very financial difficult situation.
Well, was there anything unusual that came to light in connection with this suspension of the dividend by the board in terms of Mr. Hartman's ownership in the company?
We started to take a look at the dividends that were coming to Al, and they were very substantial, which was fair since he had the significant stake in the shares of the company. But after the dividends were discontinued, then it came to our attention as a result of an employee that Al was continuing to accept misappropriated funds in the guise of dividends, but it couldn't have been dividends because dividend had been discontinued. The board at that time became very concerned, did investigation. We realized that Al had received over $200,000 in funds from the company to which he was not entitled to. And of course, part of the board's responsibility is to safeguard the funds. They really belong to the shareholders. They don't belong to Al. And Al was using the company almost like a piggy bank there. He needed $200,000, just took it. And at that time, the board took a hard look. We met with Al on more than one occasion and demanded that he return the funds to the company. Al was not very interested in doing that. He came up with various excuses for why he didn't want to return the funds. And then he offered to return the funds in the guise of shares being repurchased by the company. But the board said, Al, we aren't buying any other shareholders' shares from them, so we can't buy your shares. And, we need those funds back in the form of cash. They came out of the company in cash. They need to go back in the company in the form of cash. And after repeated insistence from the board, did return the funds to the company.
Do you remember, Jack, at this time, who was on that board? We had 5 board members, the 3 of the executive committee, and Mr. Hartman, and one other.
Yeah, I believe Horst Schulte was our
Right.
other member. Him still was on the board at the same time.
And did Horst participate in the decision to get the money back?
Horst was probably the most demanding. He had never seen anything like this. He was, I think, outraged is the right word. That cash needed to come back to the company because it was the company's cash.
Was this the beginning of your questioning the trust you had in Mr. Hartman from the beginning when you called him a friend and decided to come into his company with him?
I must have admit, I still considered Al a friend, but wait a minute, friendship doesn't have anything to do with taking money from the company that you're not entitled to. You got to put that money back, and you got to make sure that never, ever happens again.
Was that the same feeling that all the members of the executive committee had going forward? And at the time that October 22 comes around, when he was removed as CEO, describe those circumstances and the attitude of the executive committee with respect to that transformational change and the practicalities of it.
And I believe that no one on the board really had animosity toward Al. We really respected him for forming the company and being the CEO over the years. But friendship has absolutely nothing to do with the board's responsibility to look out for the best values of the shareholders. We started taking a hard look at Al's qualifications to continue managing the company. And even though we had no animosity toward him, we did have to protect the shareholders. And when we realized that we had to discontinue the dividends, that he had taken money from the company to which he wasn't entitled. And then we found that even though the board had told him that his number one priority was to get our $259 million of debt refinanced, and when we instructed him to do so, interest rates were unusually low. And he could have, with careful attention, had that debt refinanced on a 10-year basis at a very low rate. But because of I think he was proud and he kept trying to negotiate a better and better and better deal, he was distracted with his other activities. Interest rates moved significantly. And all of a sudden, the company could have done nailing down 10-year debt at a very cheap rate. That opportunity escaped from us, and all of a sudden the company was in real danger because we had 259 million in current asset because the debt was coming due in just a very short number of months. Al did not have a plan to refinance that debt, which meant that the lenders would have seized the company, sold the assets, shareholders would have received nothing. That would have happened if the board had not aggressively taken action.
Well, the board did it in two steps. He was removed as CEO, and then you mentioned the negotiation side of it. Did the board attempt, after the executive committee was formed, to solve this problem? And do you recall the situation in around March of 22, the long negotiating session that we all had with him?
Yeah, but I must say, even after we relieved Al of his responsibilities as CEO, just because we lost complete confidence in him, we had no animosity toward him. And in order to try to soothe the situation, we offered him the position, and he accepted the position of executive chairman, a paid position, in fact, an attractive salary. So we were looking forward to going forward with Al, taking advantage of any expertise or contacts that he had so that we could build a company. And he led us to believe that he was very interested in being part of the company and moving forward. But in March, we had sat down with Al, the existing members of the board, and Al in a negotiating session to try to smooth everything out so the company would have a very straightforward path. And we actually negotiated with Al for 10 hours. At each point of the negotiations, we agreed as to what the process would be for going forward. We wrote it down, and at 10 o'clock at night, when we were ready to sign the agreement to get rid of any type of barriers that could be to moving forward, I refused to sign the agreement. And that's when we knew for sure that Al was on a completely different trajectory from the rest of the board.
And he stayed as a board member, but he was removed shortly after that as executive chair of the executive.
That is correct. We had him as executive chairman with the salary, with the idea that he would cooperate, that he would be a part of, that he would help the company grow moving forward. And there in March, in that meeting, we discovered that his interest was held much higher than the interest of the other shareholders. And the board, the executive committee said this cannot exist. All shareholders need to be treated equally, including Al, with all the other shareholders. We are not going to elevate Al and his interest above the interest of the other shareholders.
So let's take this opportunity to accelerate forward. The board went forward, the executive committee went forward, moving later in April of 23 to adopt a pivot plan, which was effectively started by Mark Torek, who we brought in as CEO in order, and we acquired Southern Star, and we're assisting in management of Southern Star. And all of that has continued since that period right up to date, including through the bankruptcy filing and all of that. But now I want to jump forward to where we are in your understanding and observing this. And I want you to tell us about how the executive committee functions, which gives you the in-depth insight and the ability on a regular basis to advise and counsel every aspect of this company and where the company is today with respect to its self-storage pivot.
Now, after Al was terminated, an executive committee was formed, and one of the things the executive committee began doing was studying what was in the best interest of the shareholders as far as investments of the company. And for months, we studied the self-storage business. And as we did that, we came to the firm conclusion that the self-storage business would be the type of business that would increase the value of the company, increase the value to the shareholder. We did that very diligently. During that period of time, the executive committee was actually meeting weekly in order to make sure that we knew everything that was happening in the company, understanding cash flow. We were taking a look at the pivot or the transition from being invested in mainly Class B and C office buildings into self-storage. And again, our strategy, which included taking advice and engaging outside experts to help us do the evaluation, that self-storage was the way to be. That period of time, acquired Southern Star, which was actually owned by that time by Mark Tork, who we had hired to be our CEO. By acquiring Southern Star, we accomplished a couple of major objectives. One of them was that we got rid of any conflict of interest that Mark might have because Southern Star was now part of Hartman 20. The other thing is it brought self-storage into the company, and we could start developing the expertise that we needed in order to grow a large public self-storage business.
Okay, if we take up, and there are items between here that I want to cover at some point. What has happened recently in terms of new opportunities that are presented to Silver Star as we speak with respect to aligning the performance of these self-storage properties with a potential capital raise?
We want to grow the company because growing the company means that we have greater ability to raise funds of which we can pay dividends. And so that is the focus. Our focus of the executive committee is on the shareholders, paying distributions to the shareholders. Very recently, we obtained a commitment, a letter from Emerson Equity for a raise of $50 million. Can use that to expand our self-storage business. I believe that would probably just be one of many, but it would be a very, very strong start as we move forward.
Emerson Equities decided to do that as a result of the performance turnaround at Southern Star and the prospective ability of Silver Star's in the field property management.
The letter from Emerson Equity offering to help us raise $50 million is not to be taken lightly. A firm in the equity raising business will not issue a letter like that unless they have a lot of confidence in management and the strategy of the company and where the company is going. They want to make sure it is well managed and that the management of the company can execute on that strategy. So again, it's a big win for the shareholders to be able to raise $50 million as we grow the company, but it is one strong endorsement of the management that we have here at Silver Star.
Tell us about the situation that materialized in 23 with respect to the market conditions, actions by Mr. Hartman to impede sales, the necessity to refinance, and just the general situation from your observation.
So Al's inability or just did not get the job done as far as refinancing the company's debt haunted us through 2023. We should have been able to have that low interest debt, and instead the executive committee is scrambling to try to make sure that the responsibilities that the company has are satisfied. At the same time, Al is doing everything that he can to get the executive committee to give him a much better deal than the other shareholders, then he can go away. That was the offer that he made to us, was if you'll pay me more than what my stock is worth, then I'll go away and leave you alone. In particular, he was demanding our 5 best buildings that in exchange for his stock and other liabilities. So the board of directors looked at that and said, Al, we're not going to treat you any better than the other shareholders. You have to be on the same level playing field as other shareholders. So your request to get our 5 best buildings just to make you go away is a non-starter for our company. We're having this discussion. We are moving forward with the sale of certain properties because we have to raise cash because Al has not arranged for refinancing of the debt. The EC is scrambling to get the debt refinanced to come up with new debt. And as we are very, very close to getting that new debt, Al forms a lien on some of our major assets called Les Pence. Later on, and this had the EC scrambling, it had our potential lenders scrambling because all of a sudden it looks like that we have a liability on our assets that was not previously disclosed. Later on in Maryland litigation, the court ruled, and Al admitted that he didn't have any interest at all in filing the Les Pence. He did it just simply to interfere with what the EC was doing to try to maximize value to the shareholders. And that just further indicates he was much more interested in burning the house down than he was in creating value for shareholders.
Thank you for your time, Jack. You've done an outstanding job. Your service on the executive committee, history with the company, institutional knowledge is valuable for every one of these shareholders and has been an aid not only with respect to the oversight controls from an audit perspective that have really been emphasized with the formation of the executive committee, with the in-depth analysis of it, and it's a pleasure to go forward with you. So thank you for today, and we look forward to visiting again.
Thank you, Gerald. It's a privilege to serve.
Thank you.